What's up, you guys? I'm Dan. This is Frugal Not Cheap. Today we're in the home office because we're going to be looking at some spreadsheets. I wanted to look at a faster way to achieve financial independence, but also look at the risks and leverage in that strategy, and that is a rental property portfolio. So I was having coffee with a new acquaintance, and we got to talking about different ways that one could achieve financial independence. And one way that we haven't really talked about on this channel, because it's not my personal path, it's not something that I'm an expert in, but I do kind of know some of the basics about, is using a rental property portfolio. And this actually is a much faster way to achieve financial independence compared to, the slow way that I'm doing, which is to invest in a diversified stock portfolio. The fast ways are a lot flashier, but they're not without risk. So of course there are some lottery winners and cryptocurrency millionaires out there, and then others who follow this path. But again, there is some risk involved. So we were talking about how this works, and she was talking about how she'd done basically a cash out refi on one of her properties, and so she was proud of not having to tie up any of her capital in order to get this rental home. And that was fine and interesting and great, but at one point she said the thing that got me thinking about this video is she said, I don't see the risk, or I don't see much risk. Then I'm thinking, well, if you got a cash out refi, then you've got some major leverage going on in there. There's definitely some risk. So I put this model together to kind of show her where that risk is. I don't know if she ever actually took a look at it, but I think this model is helpful. And I think there might be some of you viewers out there that are thinking about going this route. And so I think this will give you something to think about. There are other resources, of course, people that are real experts that know a lot more than I do about this. So two of those resources, and I will link them in the description below, are Bigger Pockets. They've got a forum and I think a website. And then also the Mr. Money Mustache forums, of course, has a landlording and real estate subsection where there's some people that really know their stuff that talk about this. So two really good resources. And the spreadsheet, by the way, that we're going to be using is also available as a resource for you. So you can download a copy and then just play around with the numbers to make sense for your area. So to make things simple, this is just going to be the rental property portfolio. We're not going to live in any of these properties. We're going to have separate living situation. So the next thing, real important number to know, is what is your rent to price ratio. So this is the ratio between 1 month's rent and the value or the price of your property. So a lower rent to price ratio, like this 10 that we have here, is really good for landlords. And a higher rent to price ratio, meaning the rent is relatively cheap relative to the value of properties, is really good for renters like myself. In the Dallas area where I am, the rent to price ratio is more like 17. So if you're going to be a landlord, hopefully you have a better number than that in the rent to price ratio, and you should do the analysis carefully before you buy your property. If you're a renter and you're looking to move to an area, then this is also a number you can look at, and the bigger the number, the relatively cheap rent is going to be. Now let's say we buy a first property for, I don't know, $250,000. And here is where we'll talk about one more item, and that is how much you're going to put down. So in order to avoid private mortgage insurance on a residential property, the property you're going to live in, you need to put at least 20% down. And PMI is quite expensive. So personally, if I were going to be buying a home to reside in, I would definitely at least be putting 20% down in order not to have that private mortgage insurance. But for commercial real estate here, we're going to assume that we're putting 25% down, meaning our mortgage balance is going to be 75% of that. So let me just copy that over. We're going to put down 187,500, and so that means we're going to put $62,500 down, and then that means that, theoretically, if we were able to do a cash out refi, then we'd be able to pull that equity out of the property again and then invest in another one. So the problem here already, though, is that in my area anyway, rent to price ratios are relatively high. That means that we're only receiving about $1,225 in rent. And we have a lot of costs. So our mortgage is going to be about $846, insurance another $73, taxes $400, maintenance at $208. And those taxes, by the way, are monthly. We did divide by 12. Then we've got expected maintenance costs and also vacancy. In my area, the vacancy rate is about 9%. So altogether, total carrying costs are about $1,640, meaning this property does not cash flow. And that's what we mean here by does it meet the 1% rule. So a sort of rule of thumb is you want to receive 1% of the property's value in rent each month in order for it to be cash flow positive. So we'll touch back on that later, but for now we can see that our property is not cash flowing. We're going to have to pay $414 on average, right? There will be times when we have no vacancy and things are going well, we don't have a lot of repair bills, etc. But on average, we're going to be paying out $414 from our own pocket each month. And we will, of course, though, be building some equity as a lot of our mortgage, the part that's not going to interest, is going to be paying down the principal on our loan. But let's say we're going to do what a lot of people did back in 06 and 07, what a lot of people are doing now. And I should point out, by the way, there's this thing called the Fed's Exuberance Index, which is kind of an indicator of, how frothy the housing market is, how likely it is to be sort of in a bubble. We were in a bubble, obviously, before the Great Recession, and we were in that bubble for quite some time. The index was in there for, I think, around at least 6 or 7 years or so. And we're just now getting into bubble territory in that index again. I'll put that up on the screen here so you can see. So we could be in this bubble territory for some time before the bubble might eventually pop. But yeah, bubbles do eventually tend to pop sooner or later. So that's what we're going to do later, is kind of stress test our portfolio for how that's going to go if and when that happens. But for right now, we're trying to build our little rental property empire. And we're very bullish on this whole thing. And we're willing to take risks like everybody else is taking risks. So we're going to cash out completely. We're going to take out all of the equity, this $62,500. And that's going to help us to buy our next property, which is going to be a little bit more spendy. It's going to be a 300 grand property. So we're going to have a mortgage balance of $225,000 because we're putting, again, 25% down. So we took out all the equity. That was a little over 60K, plus about another 13K or so in order to make this 75. And that's where we are now. So now we have 2 properties, but because our rent to price ratio is not good, then now our carrying costs are about $1,000 a month. But we've got a good paying jobs, and so we're able to carry this. And again, we're knowing that eventually down the line, these mortgages are going to be paid off, and then our overhead will be much lower. And so we'll just be bringing in a lot of this rental income without having to pay off this loan and the interest as well. So that's going to be good. But we continue to be bullish, and we're going to build up our property empire here. So we're going to buy another one for $350K, let's say, $262,500. We're going to cash out all the equity in this property, so there's another $300,000. Maybe we've had a little bit of appreciation here, so this value is going to like say $260,000. You know what? I'll do those at the end. And then we go on again, for the next property and the next property. And our crown jewel here is a $500,000 home, right? Depending on your area, that may or may not be a lot of money for a home, but this one won't have appreciated, and we'll have the $375K in. And so let's say this one, is now to $310,000. This one's like, I don't know, $360K. But we have $350. There we go. So there you go. So we've had a little bit of appreciation in the properties that we've had for a while. They've appreciated by about $10,000 each. Not in the most recent property before, because we cashed out and refied to get this fifth property, where we did put $125K down. But again, that's only 25%. So if you've been looking at these numbers, I hope you can see where the leverage is and where the risk is. So in total, we've deployed $155,000, right? But our total debt load here is $1.68 million, $1.675 million. So that's where the leverage is, right? Each time we do these properties, we're only deploying 25% of the property's value in order to control the entire asset. So that's where the leverage is, right? It's a 1:4 ratio for the first property. But then as we cash out, refi to get the second property, then the leverage increases. Now we're at 1:8 or so, 1:9 maybe, and so on and so forth, until at this stage, the ratio is really, really large in terms of our leverage. And so obviously that's going to be risky. To make matters worse, we're now very cash flow negative because the rent to price ratio in the area is not very good. But we do have a little bit of equity in the homes, and so let's say that I lost my job at this point. Well, I won't be able to cash flow out of my wage income, the $3,400. But what I could do, because we have some equity, is sell property number 5. Right? It's worth $500. We owe $375. We'll have $125K, and that'll help me weather the storm until I get another job, and I can continue to cash flow the remaining properties, which would cost me $2,924. Right? So I'd be able to do that. The big problem comes if there is actually another shock to the real estate market. And these shocks don't tend to come on their own. So when we had the Great Recession, not only did home prices fall by 33%, but the other thing that happened, of course, is we had a big recession, and so people lost their jobs. And so that means that our tenants are likely to hit financial trouble too. And so let's say we have 5 properties, but still it's a pretty adverse event. We'll say 3 of them end up having 50% delinquency above and beyond the base rate. So we're not saying we're not going to have any income at all for the whole year, just that things are 50% worse than normal above and beyond the 9% delinquency rate that we normally have. And so now here's our situation, right? So we have new home values that are much lower. You can see we have negative equity now in all the properties. All 5 are underwater. And then because we have this delinquency, which is costing us an extra $2,700 a month, then our new monthly cash flows are negative $6,100 on average for that year. And that's going to be really, really hard to carry, even if I still have my job. To make matters worse, though, again, because it is a recession, it is entirely possible that I could lose my job too, be out of work for, I don't know, even up to 6 months or more, trying to carry this, and I'm really, really in trouble. Because what? I can't sell my properties anymore, because all of my properties are underwater. So they're all going to get repossessed, right? We're going to go into foreclosure, and my real estate empire of $1.8 million, right? Actually, the total value, $1.83 million. My real estate empire is going to crumble because I had too much leverage in the system and I was not able to weather the storm. So what would be, I don't know if it's the right way, but how would I do it? If I was really, I wanted to be a landlord and I wanted to put up with all this stuff and I was really handy and I could do the repairs and I love dealing with the people and what have you, all the stuff that I don't want to do, which is why I don't do it, right? And I really was more ambitious about getting rich quickly, let's say too, and I was willing to take this risk. How would I do it? Well, first I'd want to have a rent to price ratio that is positive, that is low enough that my properties are cash flowing. So where's the break-even point? It's around 12 is the break-even point for my local market, given the numbers here. Yours might be different, so you might have to tweak sort of the taxes, obviously. Also mortgage rates you might have to tweak. And then your local vacancy rate might be different as well. The maintenance costs are based on 1% of the value per year, and then you divide by 12 to get the monthly. So roughly around there, let's say it's better than that, right? I'd want to go so that I'm actually making some money, not just kind of treading water. So I'm going to go for a rent to price ratio of 10. And then what I would do is when I bought each property, is at the beginning, I would want to have 25% down, and I'd wait until I had equity of 25% before moving on to the next property. So we'd be at $195K on this one. There we go. So that's where we are, kind of in a worst case scenario. I didn't add any further appreciation in the properties. So now we have 25% down our equity in all of our properties. And so the leverage ratio is much, much better. We have a total equity of almost $460,000, again, against $1.83 million. So it's looking a lot better. In fact, we could do, let me do this real quick for us here. So this is still, again, the 1-to-4 ratio. Whereas before, when we had like 0 equity, let's just quickly do that, sorry. And you can watch the numbers jump, right? So this is kind of where we were before. Is like now, you know, we're at a 7 to 100 ratio. So, you know, really much worse than a 25 to 100 ratio. All right, but let's go back to our good scenario here. I'm going to leave that in there for you guys for the model. So to me, the 1% rule, actually, we need a rent to price ratio of 8, which is quite good. So we're going to go with that, actually, just because we really want to do sort of the ideal scenario. So we're meeting the 1% rule now. And look at our cash flows, man. We're making $5,774 in positive cash flow each month. And that's above and beyond the fact that we're also paying down our principal on our properties. So then even if we had a Great Recession type event and we had prices fall by 33% and we had 3 out of 5 of our properties delinquent, then still, even though, yes, because we only had 25% equity and prices have fallen by 33%, we're underwater on all the properties. We're not that far underwater, and our cash flows are still slightly positive. So as long as I don't lose my job, then the system is still going to be able to take care of itself, right? As long as I don't lose my job, I'm okay outside of the property portfolio, and the property portfolio on average is still going to be able to take care of itself. So we can see this is a much less fragile system, right? And of course, prices won't stay that low. So because I'm able to hang on, then prices will eventually recover. And now they're only 20% down, right? Let's say. So in this scenario, where home prices have dropped by 20%, I've still got some equity in the system. And so even if I lost my job, let's say, I'd be able to sell one of these properties. Maybe I could sell property 5. I would still have $25,000 in equity, and then I'd be able to then cash flow, you know, myself for a little while until I got another new job, and then the rental property portfolio again would still be taking care of itself. It'd be cash flow positive on its own. So this is a much less risky system. Of course, the ideal one is that eventually you have all of these mortgages paid off, right? And so now this is the amazing scenario, which is once they're all paid off, I'm making 12 grand in positive cash flow, right? So even under, you know, the Armageddon scenario, I still have positive cash flows at $6,600 from the system. So this is the eventual goal, is to get the properties paid off and not continue to grow so much, because as we continue to grow, then we continue to increase the leverage in the system. Yeah, this is a pretty cool goal, pretty awesome place to be. And certainly one way to go. It just happens not to be the way that I would want to go personally. I just don't have the inclination to be a landlord. It is possible at one point I might like buy a duplex and then rent out the other side or something like that. I'm not sure. Yeah, we'll just have to see. Or if I ever bought a home and we happen to move, then I might consider, depending on what the market looked like, renting it out instead of selling it. But no plans for that right now. But anyway, very viable way to go. I hope this video helped you get an idea of how this would work. Also, do check out the other resources, Bigger Pockets, and the Mr. Money Mustache forums, linked in the description below, along with the spreadsheet. If you did find this helpful, do please hit the like button and consider subscribing. It would really help out the channel. Thanks again for watching, and I'll see you in the next video.